Hi, everyone. Meet Jim. Jim is the ultimate average American. For 30 years, he did exactly what the system told him to do. He worked hard, never missed a credit card payment, and saved every spare penny into a safe savings account at one of the big four banks. To Jim, that account was his fortress, a shield against the math of being broke. By 2023, he had finally hit that major $100,000 milestone, a threshold where he thought his money stress would finally stop. But here is a harsh truth that Jim didn't see coming. Over the last 3 years leading into 2026, a set of hidden mechanisms, the ones I spend way too much time obsessing over, went into overdrive. While Jim's bank balance stayed the same, his purchasing power was being quietly liquidated. Between the 2026 cost of living spikes and the insulting 0.01% interest his bank paid him, Jim didn't just stay stagnant. He effectively lost 30% of his wealth. That $100,000 he sacrificed decades to build, in 2026, it only buys what $70,000 bought just a few years ago. He did everything right, yet he's ending up broke because he trusted a system designed to use his loyalty against him. Here is what the bank teller will never tell you. Your safe savings account is actually a slow-motion robbery. While the big banks use your income to fund their own growth, they hope you remain lazy enough to keep your cash in accounts that don't even reward your loyalty. In fact, big banks actually fear people who understand how to move their money. My name is Chris, and on this channel, we don't follow the average American script because, in 2026, that script leads to financial extinction. By the end of this video, you won't just see the math of why you're losing money. You'll know the exact 3 places where the quiet wealthy are moving their cash right now to stay financially stable while everyone else is being manipulated. If you're ready to stop being the bank's favorite victim, stay tuned. Because the window to protect your first $10,000 or $100,000 is closing faster than you think. Let's talk about the psychology of the convenience tax. Why is it that millions of Americans, from 22-year-olds just getting their first paycheck to 70-year-olds living on Social Security, continue to keep their life savings in accounts that pay almost zero interest? It's because of a hidden mechanism of wealth extraction that I'm going to show you shortly. The banks have successfully branded familiarity as safety. You stay with a Big Four bank not because it's the best financial decision, but because their app is already on your phone, their ATM is on your corner, and moving your money feels like a monumental chore. The banks are betting on your financial inertia. They need you to be just lazy enough to ignore the math, because your laziness is their primary profit center. Here is the great deception in plain English. When you deposit $10,000 into a standard big bank savings account, they might give you a staggering 0.01% APY. That's about $1 a year. Meanwhile, that same bank takes your $10,000 and lends it right back out to your neighbor for a pavement princess truck loan at 8% or to a college student at a 25% credit card interest rate. This is what I call the math of being broke. The bank is essentially using your capital to fund the very traps that keep other Americans financially unstable. They are the middlemen who take all the profit while you take all the inflation risk. In 2026, the gap between what banks earn and what they give back to you has reached a harsh truth level that most people simply can't afford to ignore anymore. Let's look at the average American financial statistics to see how this gap is widening. Currently, 75% of people never reach a $100,000 net worth, and a major reason is that they are splitting their money wrong. While the big four banks report billions in quarterly profits, the average net worth for a 30-year-old in the U.S. is shockingly low when you strip away debt-fueled assets like cars. The system relies on you staying below the $20,000 threshold. Why? Because, as we've seen in our studies of wealth milestones, everything changes after you save $20,000, but your bank hates it when you hit that number. Once you have $20,000, you have optionality. You have the power to walk away. But as long as you have less than that, the bank treats you like a target for fees rather than a value partner. This brings us to the loyalty trap. We've been conditioned to believe that being a long-term customer earns us better treatment. But in the world of 2026 finance, loyalty is a liability. Just like your car insurance doesn't reward you for being a perfect driver, big banks don't reward you for being a 20-year customer. In fact, they do the opposite. New customers are often lured in with $200 sign-up bonuses, while you, the loyal customer, are hit with monthly maintenance fees if your balance dips too low, or overdraft protection fees that cost the bank $0 to execute but cost you $35 every time. They are effectively charging you a subscription fee to let them gamble with your money. They want you to stay in their ecosystem because they want to sell you the buy, borrow, die loophole, but only the version where they're the ones getting rich. They want you to tell them your income so they can calculate how much more debt they can safely sell you. They aren't looking at your savings account as a way to help you retire. They see it as collateral for the next loan they want to sell you. If you feel like you're making six figures but still feel broke, you need to realize that your choice of bank is part of the hidden signs that you're losing money without realizing it. You are being manipulated to stay in a system that was never designed to make you a millionaire on a low income. The big banks hope you miss the credit score loophole and keep focusing on looking rich rather than being rich. They need you to keep your money in their leaky buckets so they can continue to fund their own expansion while you struggle to keep up with the rising cost of groceries and housing in 2026. But here's the thing. The quiet wealthy don't play this game. They understand the rules of money have changed. They know that in 2026, keeping a large amount of cash in a big bank savings account isn't safe. It's a guaranteed loss. Let me start by explaining the math of being broke to you. If you've ever looked at your bank account after a month of hard work and thought, I'm making six figures, so why do I still feel broke? You are not alone. In 2026, the average American is dealing with a financial landscape that has fundamentally shifted. Things that used to be worth it simply are not anymore. You might think that keeping your cash in any of the four big banks is the safest move you can make, but as I've spent way too much time obsessing over the hidden mechanisms of wealth, I've discovered a harsh truth. Your money isn't just sitting there, it's leaking. This is what I call the math of being broke. It is a system where you are essentially forced to pay double for everything because of how your capital is managed. To stop this, we have to identify the three specific leaks that are quietly liquidating your net worth while you sleep. Leak number one, the maintenance fee or subscriptions. The first leak is the most insulting because it's a fee you pay just for the privilege of letting a billion-dollar institution use your money to get richer. In 2026, banks have become masters of the loyalty trap. They know that if you've been with them since you were 20, you're unlikely to leave. So they stop competing for your business and start looking for ways to monetize your existence. Think about this. Why do banks want to know your income so badly? They are not asking because they want to help you reach your major money milestones. They want that data so they can calculate exactly how many fees they can squeeze out of you before you notice. Whether the $12 monthly maintenance fee because your balance dipped too low or a convenience fee for using an out-of-network ATM, these are non-obvious signs that you're losing money without realizing it. If you are one of the 75% of people who have never reached a $100,000 net worth, these small fees are the friction that keeps you from ever gaining momentum. They are the membership fees to a club that doesn't actually want you to succeed. The system is designed to keep you manipulated to buy in 2026 rather than save. Every dollar you pay in fees is a dollar that isn't working for your future self. Leak number two, the opportunity cost. This is a 5% yield gap. The second leak is silent, and it's the one banks fear the most, especially if you're someone with $20,000 saved. Why does life get so much easier after you hit that $20,000 threshold? It's because $20,000 is the exact moment where the math of interest starts to become a second income. If you have $20,000 sitting in a big bank savings account at 0.01% APY, you're earning roughly $2 a year in interest. But in the current 2026 market, there are safe havens, which I will show you shortly, offering 4% to 5% or more. The difference between that 0.01% and 5% is your opportunity cost. On a $20,000 balance, that gap is $1,000 every single year that you are essentially handing back to the bank as a gift. This is a major mistake people make. when they hit their first $10,000 or $15,000. They feel safe because the number in the app is staying the same, but they are ignoring the 8-4-3 rule of compounding. If compounding feels too slow for you, it's probably because you're trying to build a fire with damp wood. By leaving your money in a low-yield account, you are effectively choosing to work harder and longer than you have to. You are being robbed of the time your money could be buying back for you. Leak number 3, the inflation gap. This one is a $20,000 to $18,000 trap. Finally, we have to talk about the most dangerous leak of all, currency devaluation and the inflation gap. This is why your emergency fund might actually be trapping you financially in 2026. In the U.S. right now, the alarming financial statistics of the average American show that while wages may be rising slightly, the cost of the big three, housing, groceries, and transportation, is rising much faster. If you have $20,000 in the bank today, and inflation is running at even a modest 5 to 7%, that money will only have the purchasing power of $18,000 or $19,000 by next year. You're not just staying stagnant. You are losing money every month. This is why people who feel like they're doing well, the ones making six figures, still feel like they are drowning. Their safe cash is being devalued by the system. The pavement princess trap, where Americans are lured into high-interest truck loans, is just one way the system ensures your cash never stays in your pocket long enough to grow. Your bank wants you to keep that cash in their vault because it gives them the liquidity to lend more money to people falling into the car payment trap. They use your dead capital to fuel their high-interest loan machines. This is the money secret keeping you poor forever. The quiet, wealthy people, those who have mastered the 8 habits of staying rich, understand that in 2026, saving is a losing game, but positioning is a winning one. They don't leave their $20,000 or $100,000 milestones in a bucket with 3 holes in it. If you want to know why everything changes after you save $500,000 or even just your first $20,000, you have to understand that the rules the banks taught us were designed for their benefit, not ours. They want you to think you need them, but the reality is banks fear people who understand the math. Now, I know what you're thinking. If the big banks are a leaky bucket, where am I supposed to put my money? Is there actually anywhere safe left in 2026? The answer is yes, but it's not where the average American is looking. The quiet wealthy are moving their capital into 3 specific safe havens that allow them to bypass the big bank fees, capture that 5% yield gap, and actually outrun the inflation trap. Next, I'm going to reveal the exact 3 places where the smart money is hiding right now. These are the moves that turn a leaky bucket into a wealth-building machine. If you want to see how to beat 95% of people financially in the next 3 months, then listen to me. We've established a harsh truth. Keeping your money in a traditional big bank account is essentially a slow-motion robbery. But if the average American script is a trap, where do you actually go? On this channel, I spend way too much time obsessing over the hidden mechanisms of wealth. So you don't have to. In 2026, safe doesn't mean familiar. Safe means your money is positioned where it can outrun the math of being broke. The quiet wealthy are not just saving. They're utilizing specific, low-risk alternatives that the big banks hope you remain too lazy to discover. Let's break down the 3 safe havens where the smart money is hiding right now. Number 1, high-yield savings accounts. The digital banks. The first place the quiet wealthy move their cash is into high-yield savings accounts. Now, I know what the older generation in the audience might be thinking. If I can't walk into a building and see a vault, is it really safe? This is a psychological hurdle the big banks use to keep you trapped in a system that rewards your loyalty with 0.01% APY. Here's the hidden mechanism. Traditional banks have massive overhead. They have thousands of physical branches, tellers, and security guards. You are paying for those buildings through the interest they don't pay you. Digital-only banks don't have those costs, so they pass that 4% to 5.5% yield directly to you. Is it safe? In 2026, these digital institutions carry the exact same FDIC insurance as for big banks, covering you up to $250,000. The only difference is that they are not trying to manipulate you to buy a high-interest truck loan or a pavement princess every time you log in. Moving your money here is one of those minimalist money rules you must follow to stay financially stable. Number 2, Treasury bills and money market funds. The rich man's loophole. The second safe haven is what I call the secret loophole that the rich use to stay rich. Treasury bills and money market funds. If you have reached that first $10,000 or $20,000 milestone, this is where your strategy must shift. Treasury bills are essentially you lending money to the U.S. government. In exchange, they pay you a guaranteed rate of interest that is often higher than any bank. The quiet, wealthy love Treasury bills because they are often exempt from state and local taxes. Another hidden sign of wealth that the average person misses. Money market funds operate similarly, pooling your cash with other investors to buy short-term, high-quality debt. This is a real power of having cash that nobody explains. It's not just about having the money. It's about having the money in an instrument that acts as a shield against currency devaluation. While the average American is losing 5% of their purchasing power to inflation, the person in Treasury bills is neutral or gaining ground. This is how you beat 95% of people financially in just a few months. Number 3, credit unions, the community wealth model. Finally, for those who still want a physical location to visit, we have credit unions. This is a community wealth model that stands in direct opposition to the big banks' profit machines. A credit union is a not-for-profit cooperative. You are not a customer. You are a member and an owner. Because they don't have shareholders to satisfy, they can offer higher interest on savings and significantly lower interest on loans. This is a crucial tool to avoid the mortgage racism scam or the car payment trap that keeps so many Americans broke. When you move your money to a credit union, you are opting out of a system that wants to know your income just so they can sell you more debt. You are moving into a system designed for financial stability, not corporate extraction. Now, here's a connection. How $10,000 changes the math of wealth. Let's look at the surprising math of why moving just $10,000 to these accounts changes everything. If you make the common mistake of leaving $10,000 in a big bank, you earn about $1 a year. That's not even a cup of coffee. But if you move that $10,000 to a 5% digital bank or treasury bill, you're suddenly making $500 a year for doing absolutely nothing. That $500 is passive income that covers your internet bill or a month of groceries. This is the exact moment when compounding stops being a theory and starts being reality. Why does life get easier after $20,000? Because at $20,000, that yield jumps to $1,000 a year. Now you're not just saving. You're hiring your money to work a part-time job for you. This is how you escape the math of being broke, where you pay double for everything. The banks fear people with $20,000 saved because once you have that much, you realize you don't need them. You realize that the safe path they sold you was actually a cage. By moving your first $1,000 or $10,000 into these safe havens, you are signaling to the system that you are no longer a target for their fees. You are choosing to be quietly wealthy. You are choosing to follow the 8-4-3 rule, where your money starts to pull its own weight. But moving the money is only step one. To truly be impossible to stay broke in 2026, you need a specific exit strategy, a roadmap to ensure you never have to crawl back to the big banks again. I'm going to give you the Chris Finance 2026 roadmap, the step-by-step habits you must start today to ensure you never lack money again. We have spent time in this video uncovering the hidden mechanisms that the big four banks use to quietly liquidate your hard-earned wealth. We have looked at the harsh truth of the math of being broke, where the system essentially forces the average person to pay double for everything through fees, inflation, and lost interest. But understanding the trap is only half the battle. To be impossible to stay broke in 2026, you need a tactical exit strategy, a roadmap that takes you from being a target for fees to being quietly wealthy. This isn't about saving more in a leaky bucket. It's about positioning your capital so that compounding actually starts to work for you instead of against you. Here is the Chris Finance 2026 roadmap, the exact steps you need to take this week to reclaim your financial future. The 90-10 bank rule. Before we hit the milestones, we need a new operating system. I am introducing a minimalist money rule for the Chris finance community, the 90 to 10 bank rule. The rule is simple but transformative. 90% of your liquid cash must live in safe havens, the digital banks, treasury bills, or credit unions we discussed earlier, while only 10% remains in traditional big bank. This 10% is your convenience fund. It is for your immediate bills and the ease of using a local ATM. But by moving 90% of your wealth out of Big Four, you are effectively cutting off the bank's ability to gamble with your future. You are stopping the slow-motion robbery of 0.01% interest per year and ensuring that the vast majority of your money is earning the 4 to 5% yield that the quiet, wealthy use to outrun inflation. This is how you stop being manipulated to buy and start being motivated to grow. Milestone number 1, the $1,000 pivot, breaking the friction. Your first major milestone is your first $1,000 saved in a high-yield environment. Saving the first $1,000 is harder than the next $10,000. Why? Because this is where the friction of the system is at its peak. When you have less than $1,000, you are the prime target for monthly maintenance fees and the math of being broke. If you are at this stage, your roadmap for this week is urgent. Stop the bleeding. Audit your bank statements for non-obvious signs of wealth leakage, and use subscriptions, convenience fees, and low balance penalties. Move that first $1,000 into a digital bank immediately. Realize that your first $1,000 feels small until it starts earning more in a month than your old bank gave you a year. This is the secret to never lacking money again. Milestone number 2, the $20,000 acceleration, the power of optionality. Everything changes after you save $20,000. This is the moment where life gets easier, but your bank hates it. Why does the bank hate a person with $20,000? Because $20,000 is FU money on a small scale. It gives you the optionality to walk away from a bad job, a bad loan, or a predatory pavement princess truck deal. At $20,000, your 5% yield is generating roughly $1,000 a year. That is a major money milestone because you're no longer just saving. You are technically earning without working. Avoid the trap. This is the exact moment most Americans fail. They hit $20,000 and immediately fall into the car payment trap or buy bad assets that make them poor. If you have $20,000, you must strictly apply the 90 to 10 rule. $18,000 should be in a treasury bill or money market fund, earning you a second paycheck of interest. Do not tell the banks your income or your plans. They only want that data to sell you the debt that will reset you back to zero. Milestone number 3, the $100,000 threshold, when money stress stops. The $100,000 threshold is the ultimate psychological victory. This is a point where money stress finally stops. The math here is surprising. Hitting $100,000 means you're already 1/3 away to $1 million in terms of time and effort, because compounding does the rest of the heavy lifting for you. When you have $100,000 positioned in the safe havens we discussed, your money is likely earning $5,000 or more annually in interest. You have bypassed the credit score loophole and the mortgage racism scam because you have the capital to dictate your own terms. You are now following the 8 habits of quietly wealthy people. You look poor to banks, but you are secretly getting rich. Now, your roadmap for this week, the 4-step audit. To get these milestones moving, you must perform this audit within the next 48 hours. 1. The fee audit. Find every dollar you paid a big bank in the last 90 days. Total it up. This is your stupidity tax for staying in a broken system. 2. The high saving yield account migration. Open an account with a digital-only bank, FDIC-insured safe haven. Move your emergency fund there by Friday. 3. The 90 to 10 implementation. Set up an automatic transfer so that every time your paycheck hits your big bank 10% account, the remaining amount is swept into your 90% growth account. 4. The payment princess vow. Look at your car or truck payment. If it is more than 10% of your take-home pay, you are being manipulated to stay broke in 2026. Make a plan to exit that trap. The window is closing. I want to be very clear with you. The average American script is a path to financial extinction in 2026. We are living through a period of extreme currency devaluation and hidden mechanisms designed to keep you broke even if you make six figures. The window to protect your wealth is closing. As the Fed rates fluctuate and the cost of living continues its slow-motion robbery, the difference between those who follow the minimalist money rules and those who stay loyal to the big banks will be the difference between a retirement of comfort and a retirement of stress. You don't have to be a genius to beat 95% of people financially. You just have to stop being the bank's favorite victim. Move your money. Follow the 90-10 rule. And start hitting these milestones one by one. If this breakdown helped you see the system for what it actually is, hit the like button so the algorithm can show this to more Americans who are tired of feeling broke. Leave a comment below. Which big bank have you used the longest? And have they ever actually called you to help you make more money? I will be in the comments responding to your stories. I am Chris, and this is Chris Finance. Don't just save your money, position it. I'll see you in the next video. Thanks for watching.